I have some good news. Not just one, but two pieces of good news. Number one, we have crossed 5 lakh followers on Instagram. How did it happen? We kept creating insightful content on finance. Many of our reels got millions of views. And we also received all of your love. And the second piece of good news is that we have also finally started our English channel on YouTube. So if you or your friends are interested in viewing our content in the English language, you are welcome to subscribe to our Vira English channel today. I have put the links for both in the description. If you follow on Instagram and subscribe to the YouTube English channel, it will help me a lot. Now let's get to today's video. Today, I'm going to share a powerful system with you, using which you can earn a dividend of around 20,000 rupees every single month. But wait a minute, this is not some random video where I'll ask you to buy shares like Coal India or Vedanta. Instead, today I'm going to talk about some very special stocks whose dividend yield is from 13 to 14% per annum, which 99% of India's retail investors don't even know about. See, most stocks in the Indian market hardly give a dividend yield of 3 to 4%. But after doing some research, I have made a list of 5 such InvITs that are giving a dividend yield of up to 14% per annum. This means by investing 1 lakh rupees, you can get a dividend of around 14,000 rupees a year. And that too, 4 times a year. Because these InvITs actually pay quarterly dividends. And do you know why that really happens? This happens because these InvITs hold real assets, where money is made every day. The full form is Infrastructure Investment Trust. Think of it like a mutual fund. The only difference is that this fund does not invest in the stock market. Instead, it invests directly in India's actual physical infrastructures, such as highways, power transmission lines, solar plants, roads and bridges. All these assets are pooled together into a trust. And when any revenue comes from these assets, generated through toll collections, power grid tariffs, or highway annuities, then a full 90% of that collected revenue is compulsorily distributed to investors. This is a mandatory rule by SEBI, which they must follow. InvITs cannot hold back their earnings. They have to mandatorily distribute them. And these InvITs are also listed on the stock exchange, just like stocks. Meaning you can use Zerodha, Grow, Angel One, Dhan, or any broking app to buy its units. The minimum investment is only around 100 rupees, which is quite less to start this with. And sometimes it's even less than that. Today I am going to tell you about 5 such InvITs, all of which are priced below 200 rupees. And there is actually one particular InvIT whose price is just 60 rupees per unit. And the expected yield is somewhere between 13 and 14% per annum. So, how much is the actual return? And here comes a number that might make you think that I am saying something very wrong. And the absolute best part is, you really do not even have to wait a whole year for this dividend. You receive this dividend quarterly. Whether the market is up or down, every quarter, the dividend will come directly into your bank account. Quarterly means about 4 times a year. In this video, we are now going to talk about 5 of India's most important listed InvITs about which a full 99% of retail investors still don't know anything about. The business model of each one, the distribution yield of each one, and most importantly, where it is wise to invest and where there is a trap. We will discuss all this with data, backed by fully verified and researched findings. We will avoid all speculation here, so please make sure to watch this entire video until completion. And once you've watched this entire video and understood it, I guarantee that tonight you will be thinking, why didn't I know about this investment before? But don't worry, better late than never. So to begin with, let us start with the Infrastructure Investment Trust that plays India's safest but most complex yield. Power Grid Infrastructure Investment Trust. It is listed on the NSE under the name PG InvIT. The sponsor is Power Grid Corporation of India, which is India's Maharatna PSU, meaning it's a directly government-backed infrastructure. It will take you just about 30 seconds to understand its business model. And then you will never be able to forget it. This trust is the owner of 5 different SPVs. That is, 5 different special purpose vehicles. And these have 11 high voltage transmission lines. It has a total network of 3,699 circuit kilometers. And the revenue generated by these specific lines does not depend on the amount of electricity that has been transmitted. Revenue comes from availability. This means if the line was available 98% of the time, it gets the full tariff. Whether it rains or a major storm comes, the government money will continue to arrive without fail. Just observe these particular financial figures, which will absolutely surprise you. The IPO price was 100 rupees per unit, issued in May 2021. Since then, for every single quarter without missing even once, it has given a distribution of 3 rupees per unit. 3 rupees every quarter means 12 rupees a year. Every year without missing a single quarter. And the current price is around 93 rupees 47 paise. This means that if you choose to buy 1 unit for 90 rupees today and you receive a distribution of 12 rupees in the whole year, your yield will effectively become 13.33%, that too on a AAA rated government backed asset. Nearly double of bank FD rates, though this is not a direct, fair comparison. Because in a bank FD, you get an insurance of up to 5 lakh. There is no such safety here. But because this InvIT is government backed, it does offer some underlying safety. And to date, since the listing, the cumulative distribution has been approximately 55 rupees per unit. Look, history shows on screen that those who invested 100 rupees in the IPO have already gotten a distribution of 55 rupees, a 55% return on their investment. The total return is meaningful, despite the price being slightly below the IPO. But there is a big risk in this that 99% of people ignore. See, in FY28, some TSAs, that is, transmission service agreements, are expiring. Analysts estimate, and according to them, this will affect the annual cash flow by about 250 crore rupees. This means if new assets are not acquired, then distributions may potentially be reduced after FY28, and the primary problem here is that the sponsor, PGCIL, has currently put asset monetization on hold. Ever since the initial listing, there have been zero new acquisitions, and this fund is currently entirely flatlined. It's safe, the yield is fantastic, but there is absolutely no growth. This InvIT is basically for those people who just want a safe and steady passive income. And we have 4 more high-yield InvITs coming up. I have also done a detailed comparative analysis of all of them later on. So watch the video till the end. Then you can decide for yourself which InvIT to invest in and how much. Now let us finally come to the InvIT that, in my opinion, is one of the top 3 most underrated investments in all of India. India Grid Trust. It is listed on the National Stock Exchange under the name IndiGrid, and you won't even believe its track record when you hear it. It had IPO in 2017 at 100 rupees a piece, but right now, its current price is 173 rupees. This means this InvIT has also given the benefit of capital appreciation. Just from price appreciation, it has already generated a 65% return. On top of that, from listing until now, the cumulative distribution is approximately 113 rupees per unit. Now just add the two. If someone had invested 100 rupees in the IPO, their total return would have been around 178 rupees by now, meaning a return of 178% in 9 years. This makes for an annualized return of approximately 13%. And this is an InvIT, not an equity fund. Still, it has given such a tremendous return. And again, you are getting returns every quarter here, meaning you get returns about 4 times a year. It's not that you got a return once after 8 or 9 years, just from capital appreciation. No, capital appreciation is extra. Besides that, you have been getting distributions every quarter. Its business model is also similar to power grids, availability-based power transmission tariffs. But IndiGrid didn't stop there. This fund also went into solar generation and went on to invest in India's first ever utility-scale standalone battery energy storage system. It has 45 power projects, 53 transmission lines, covering 9,336 circuit kilometers of total length, and 16 electrical substations as well. It also maintains a total solar capacity of 1.5 gigawatts. This is not just a fund, it is a mini power empire. Just look at the AUM. When this fund was first listed, its AUM was about 5,000 crore. Its AUM is now around 32,800 crore. It has grown by 6.5 times, that too in just 9 years. This is the result of systematic acquisition. And indeed, this InvIT is showing one of the best and fastest growth rates. Now, see the real magic of distribution. Distribution per unit in FY18 was 9 rupees 57 paise. It reached 15.35 in FY25, with 16 rupees guided for FY26. The payouts are increasing consistently every year. There was a slight dip just once in FY22, but it recovered from that situation immediately. This certainly demonstrates the track record of a fund that is dealing honestly with its investors and is showing very consistent growth along with regular, reliable distributions every single year. The current distribution yield is approximately around 9.5% if I consider the current price of 165. But for investors who bought at 100 rupees, earning 16 rupees in distributions means the yield becomes 16%. This may seem a bit less than Power Grid. If you just look at the past year, it has actually given about 13% capital appreciation and around a 9% distribution yield. That means a total return of about 21%. But these numbers are not guaranteed at all. There is no guarantee that you will get capital appreciation in the future, as beyond the power transmission, there exists another asset class where money is made every day. That particular asset is road assets, toll roads and highways. The traffic movement here is very high indeed, and big money is made too. And the next InvIT actually owns just that. This is actually an InvIT that 99% of the general public have never even heard of. I am very sure that you personally haven't heard of it either, because it was listed only in March 2024. So it is relatively speaking brand new. It's been 2-3 years, but the model is very powerful. Its business model is the most unique and safest. Among all existing road InvITs, this one is the safest. You know why? Let us understand. It invests in pure HAM assets, hybrid annuity model. This basically means that NHAI, the National Highways Authority of India, makes these contractually guaranteed annuity payments. No matter what the traffic is, the money will definitely come. That's confirmed. This means the performance risk is almost zero. there is zero traffic risk. It is essentially like a business where your customer is the government itself, and generally, it never ever makes any late payments. And that's precisely why I said that of all the highway InvITs currently available in India, this is without a doubt one of the safest. Now, let us come to the next point. Its IPO came in March 2024. The IPO price was 100 rupees per unit, but the current price is approximately 125 rupees. In just 2 years, it has already given a capital appreciation of 22%. The IPO guidance initially projected an annual distribution of 11.5 rupees per unit. The actual cumulative distribution per unit was in fact 14 rupees 20 paise. This outcome is significantly higher than its original guidance, providing a very strong signal. In FY26, from Q1 to Q3, a distribution of 10 rupees has already been received. On an annualized level, it can be up to 13 rupees. The current distribution yield actually stands at approximately 8 to 8.5%. But if I consider 13 rupees, then this yield will become 11%. And on top of that, a price return of 22% has already been received. If we look at the total return in just 2 years, it can reach up to 33%. According to the distribution of 13 rupees per unit, the current distribution yield is approximately 11%. And on top of that, it has already given a price return of 22% in the last 2 years. Yes, that's correct. Meaning if we talk about the returns of just the last 2 years, we can observe a 22% price return combined with an approximately 20% distribution yield. That means a 42% return has already been received from the IPO till now. The growth in this is extremely aggressive. A total of 9 HAM road assets are still available, and 7 additional acquisitions are going to happen soon. The SPA has been signed in early 2026 itself. AUM will exceed 10,500 crore by fiscal year 26. Right now, it is 6,737 crore. This fund is scaling fast. Indus Infra Trust. Its name on NSE is Indus InvIT. Its name was formerly Bharat Highways InvIT. The name was changed in November 2024. This specific fund is from the GR Infra Projects Group, which is one of the top highway developers in India. Where is the risk? It's the youngest fund. It has a limited operational history. There are a lot of related party transactions because all acquisitions are happening from the assets of the GR Infra Group. And the debt will also increase as the fund acquires more assets. But it has a AAA rating from both CRISIL and CARE. And the government annuity dependence is a sword, with both an upside and a risk. This fund is best for those investors who ideally want to take an early mover advantage in this area. If you want to make long-term returns by entering a growing fund, this could be the right opportunity. But remember one thing, no investment is completely risk-free, and InvITs have their own risks. Now, the next InvIT is one of the most favorite InvITs of the rich, on which some of the world's largest sovereign wealth funds have placed their bets. And in 2026, it's finally going to be publicly listed. This means a very rare entry window is about to open for retail investors. Cube Highways Trust. It is listed on NSE as Cube InvIT and is currently privately placed. But in February 2026, unit holders approved its conversion into a public InvIT. The implication here is that approximately $600 million or 5,000 crore rupees is expected via public offering in 2026. Look at its investors. Abu Dhabi Investment Authority, that is ADIA, British Columbia Investment Management, Mubadala, IFC, I Squared Capital, Mitsubishi Corporation of Japan, and Highways International. These major players don't just randomly invest in any fund. These are actually major sovereign wealth funds whose expert research teams function at a professional global level, when these entities themselves bet on an infrastructure fund. You should realize that retail investors must pay attention here as well, although I am not suggesting that you simply invest all your money blindly. But you should definitely do your research. Talking about their assets, they have 27 road assets. A total of 2,005 kilometers in 12 different states. The AUM was around 36,000 crore till December 2025. It is one of India's largest road InvITs. The average remaining concession life is more than 18 years. This means there is still a long runway left. If you look at the distribution history, you will be amazed. In FY24, the total distribution per unit was 10 rupees 9 paise. In FY25, it reached 11 rupees. By Q3 of FY26, 10 rupees 20 paise was already distributed. Meaning the full year return can go above 13 rupees. The current price is running around 140 rupees per unit. Assuming a distribution of 13 rupees, the total annual yield is currently sitting at about 9% per annum. The IPO launched in April 2023, while trading began starting from September 2024. In the last 3 years, the unit price has reached from 100 rupees to 140 rupees. So if we look at the price return, from listing till now approximately, 40% has been received. Also, a distribution of 30 rupees has also been received. So the total return, when including the distribution from listing until now, is definitely sitting at approximately 70% in just 3 years. But there is a very big risk in this InvIT. 85% of the revenue is toll-based. This means it is dependent on traffic volume. By the way, this is like a double-edged sword. When traffic volume is high, income is also high. But if traffic is low, the toll income falls, and so does the income in the InvIT. This fund is therefore suitable for people who can handle a slightly higher amount of risk and are ready for revenue that depends on high traffic. The average remaining concession life is more than 18 years. This means there's a long runway. Short-term volatility will be less. Long-term returns can be made. By the way, the distributions received in these InvITs are divided into 3 parts. And now we finally come to the InvIT that was truly the pioneer of road InvITs in India. But its own track record really teaches an important lesson to every investor. IRB InvIT Fund. Its name on NSE is IRB InvIT. It is recognized as India's first ever publicly listed road InvIT. It listed in May 2017. The sponsor, IRB, here is. One of the top BOT road developers in India. The IPO price was 102 rupees. The current price is approximately 62 rupees. Meaning, this basically means that if we look from the IPO listed price, there has been a fall of almost 40% till now. Straight away, from the IPO till now, 40% of the capital has eroded. But the distributions are very high. If we look at the cumulative distributions, they are approximately 79 rupees per unit. So if we calculate the total return, the current price of 62 rupees and the distributions of 67 rupees that have already been received, the total comes to 129. And if 102 rupees were invested, then a positive return of 26% is made. But that's in 9 years, which is a long period. Look at the distribution trend. In FY19, the distribution per unit was about 11 rupees 30 paise. But after that, the distribution per unit has been in the 7 to 8 rupee range yearly. The fiscal year of 25 saw 8 rupees per unit, while FY26 dropped to 7 rupees. And now, the guidance for FY27 suggests that it could be around 6.5 rupees, which is about 20% less than FY25. You might wonder why DPU is dropping. Why is this company reducing its distribution every year now? See, the reason is quite simple. Because this investment fund conducted massive debt-funded acquisitions throughout the entire FY26. It has acquired assets worth 9,600 crore. Due to this, borrowings have exceeded 6,500 crore, which was only 3,198 crore rupees back in the month of March 2025. Total debt has actually doubled within 6 months, and because of that additional debt servicing, the final distribution has been cut a little. Remember one more thing. The Omalar-Salem concession will expire in January 2027, which in turn contributed 8 to 9% to the net distributable cash flow. There will be pressure from this as well. Is all of this bad? Look, not necessarily. The management's plan is to target an AUM of 40,000 crore in the next 2 years, which is more than double from today's levels. If the execution remains right, then the distribution can recover in the future. However, this fund is still not suitable for those who want a truly guaranteed and stable income. This specific fund is an important lesson, not just in InvITs, but in every single investment. Dividend distributions can be cut unexpectedly. A high payout today might be much lower tomorrow, and sometimes your capital can even erode. The long-term track record really matters. That is exactly why you should never blindly invest in any high-yield instrument. First, understand the full picture. Analyze the InvIT in detail, and only then decide to invest. There are about 3 to 4 more such good InvITs, which I have actually covered in great detail in this video. Do go ahead and check it out. The video already has 1.5 million views, so you can easily understand how excellent that content must be. And if you desire to earn a fixed monthly income, then do check out this video of mine. In this, I have told you 5 such ways by which you can, every month, without doing any work, earn 100% passive income. And not just a small amount, but a pretty good income. And if, just like InvITs, you want to invest in India's luxury malls and earn regular rental income, then you must check out this video. In this, you'll see how. You can easily invest in India's top luxury malls with just 200 rupees and see exactly how Apple, Gucci, Prada stores can help in earn and rental income from these stores of such luxury brands. You will understand that as well. Now, for your most important question. If you want a dividend of 20,000 rupees every month, then exactly which InvIT should you invest in and how much? I mean, how many units will you have to buy in total? See, I have placed the full list in the description box. Please do check it out. However, remember that the provided list is based solely on today's market prices. If the price and distribution of each InvIT changes tomorrow, then accordingly, you will have to change the quantity a little bit as well. If you found this video helpful, please be sure to like it, and for more insightful videos, subscribe to our channel.